All right, everyone, welcome to another episode of Portfolio Talks. This is the show that you're going to come to learn about money, have conversation around money that you're not usually privy to because, let's face it, no one likes talking about their finances and no one likes talking about the real stories behind the money. This is a spot where you can learn from that. And as always, if this gives you value, if you've enjoyed our previous shows, please subscribe, like, share, because there's only upside when it comes to talking about money and having your friends and family talk and learn about money as well. So today we're talking about something that's going to be potentially fun or potentially PTSD for you. I'm not sure. It depends. But we're talking about mortgages. Although it's been RSP season for us here in Canada with the March 3rd deadline, a lot of the conversations we've been talking to our clients about RSPs, and then the clients segue right away into the mortgages. Because Tyson made a really good point on our last conversation. Pretty much all of our clients, regardless of income levels, the vast majority of their expenditures are all tied up in their mortgage or mortgages. And that's going to be something that I think that we would, you know, be doing a failure if we don't talk about it, about what we're seeing. So buckle up. Today's going to be about mortgages. So luckily for you, you have Mike. We have a Mike here from the HomeHappy team, and he is our resident expert, anything to do with mortgages. And then Tyson and myself from portfolio planning. We'll talk about it from our lens as financial planners and kind of what we see with our clients. But uh, Mike, maybe just kind of lead us off. Like, what's the sentiment around the mortgage landscape right now?
Yeah, I mean, there's a lot of mortgages coming due right this year. You've heard about the mortgage renewal wave or whatever media brought up, but basically it means that a lot of people took out a mortgage in 2020, and it was a low rate mortgage. They were in the ones and the twos, and they took it for 5 years, and it sounded awesome. But now they're getting close to the time it's going to come due, and they're terrified because their payment is going to go up a lot. And it is reasonable to be terrified because it is a significant impact on a lot of people's budgets and scary. That said, I mean, rates have come down a little bit from where we were, so that's the good news. I mean, it's not as terrible as it was going to be. But I think in general, people need to think about this stuff and not wait till the day before renewal and try and decide what they're going to do. And that's really the biggest issue. Is if there's two of you, have a discussion, talk about your budget. Where are you at? What's going on? What's important to you to keep, and what's important to you that you could get or that you're okay with getting rid of. And you both got to be on the same page because it's going to be something where it's going to impact your lives. And there's some good ways for us to like make it not so bad, but you still have to deal with it. So, in the last 5 years, your payment was really low. Most people didn't increase their payments, even if they could have afforded it, and perhaps took on other debt because they had room to do that and bought a car or whatever it is. So this is the time. Let's talk about it. Go over what you've got. Maybe use some of the equity in your property to uh, look at your overall payments and try and reduce it down to one single payment that is either the same or less than what you were going to pay out with all of it. That's usually one of the best ways we can find to solve these problems. I always believe that if you're paying out five different payments, it's going to be hard to focus on paying those down. If you've got one payment and it's in your face every month, you can keep an eye on it and start to get rid of it. The other thing is, don't give up on your investments uh, and take that money that you're putting into investments away to just cover your debts. I mean, that's where I'd much rather see you refinance, pay out all the debts. Now you've taken your, say, $4,000 a month you were going to pay. Now your mortgage is 3,000. You can keep the $1,000 going towards investments and not lose big. So that's a lot of talk on my side. But I mean, in general, everybody's situation is individual, and it just depends on what your long-term goals are. But I think don't lose track of that long-term goal. Don't freak out about the right now. Let's figure out a way to look at the long-term picture and keep those plans alive.
Absolutely. When it comes to mortgages, we see a bunch on the financial planning side. So, I mean, Tyson, we talk about this. I think me and Tyson talk probably three times a day, every single day. But when it comes to what we're seeing with our clients in regards to their mortgages, what are you kind of seeing?
We kind of see the gamut, and I think that we in the last year we've brought on a lot more clients that are kind of in that higher income bracket, and so their mortgage payment of three, four, $5,000 a month is not that big of a deal for them. But for like my legacy client base, I used to work exclusively in the family market. Husband and wife have a job, maybe if they're doing well, they have 120, $150,000 household income. you know, a three, four, $5,000 mortgage payment is killer for them. I mean, it's a real anchor on all of their things. And so, you know, when Mike says we want to refinance you so you can keep investing into your long-term investments and still pay down your mortgage, you know, I think that's key because so many people get wrapped up into I want to pay off my mortgage first and then I'm going to start saving money. But we're also seeing more and more people go into retirement with a mortgage. So we have to have realistic conversations of, you know, when are we paying off this mortgage? Like, are you going to upgrade your house? Because it's not very common now for people to stay in the same house for 25 years, pay it off, and then do something else. I think we've kind of been trained and groomed that you should upgrade your house every 10 years or so. And it's very normal for people to do that. But they don't look at the mortgage cycle and like when a payment's going to end and like when am I going to have freed up cash flow so that I can, you know, contribute to my investments, I can retire, I can travel, I can do other things. So it's a balancing act that is I wish I could say it was easy. It's easy from our point of view because we're just going to tell the clients what to do. Hey, don't spend money on that and do this instead. But when you're cutting into fun and lifestyle and um, that keeping up with the Joneses aspect, is then we go from being the good advisor to potentially being an adversary.
Yeah, yeah.
And
Honestly, yeah,
you go ahead. Go ahead.
yeah. I was gonna say honestly, like the reality is, if you are watching this in 2025 and your thought process is I'm going to pay off my mortgage and then once that mortgage is paid off then I'm going to start investing all my income of that, you know, $3,000 to $6,000 a month into investments, it's probably not going to happen. The reality is you are most likely not going to live in the same house for the full 30 years. And even if you do, you're probably going to spend money on renovations at some point in that 30 years. And how are you going to pay for that? With a home equity line of credit. And I got to pay that off again. And even if you don't do that, chances are you're probably going to want to help your next generation with a down payment. Where's that money going to come from? Your mortgage, and they're going to pay that off again. And even if you don't do that, chances are something's going to need to be repaired in your home, your roof, your furnace, a leak, whatever it is. Where's that money coming from? Your home equity line of credit, and they're going to pay that off again. So the reality is you're probably not going to be in a situation where you're going to pay off your mortgage in full ever. And even if you do, the all your wealth is going to be tied into your mortgage. So if you want to start to access that wealth, you got to start to do a reverse mortgage or to refinance your property or downsize or whatever that may be. So you don't have a lot of control with your money. You're very susceptible to swings and things that are out of your control. And the only way you can access the funds because you weren't saving all this time, you're just paying off your mortgage. The only way you can access your funds is to go further into debt, aka your mortgage. So numbers show that you're going to be much further ahead if you attack both. So you're having compounding working for you on both ways. So you're compounding your debt repayment with accelerated payments at the end of your year or doing biweekly payments or whatever. Mike and the brokers can help you with that. And compounding can also help you with investing when you're young and having that money grow for you. That's fully in your control. It's fully in your RSP. It's fully in your TFSA. It's fully in your corporate, holdings, whatever that may look like for you. But it is a very dangerous strategy to be like, I'm going to pay off my mortgage in full. Then once I'm mortgage free, I'm going to feel great and I'm going to start investing then. Number one, you may not have time. You may not live long enough. And you're going to be very susceptible to if something goes wrong with that home, you're going to have to tap more into debt to do that, or you're gonna upgrade your home or something. So I would be very, very, very cautious of if you're listening to this and you're like, I'm gonna pay off my mortgage, really think about that and really think if that makes sense or if you should do an alternative strategy and see what makes the most sense for you. But Mike, sorry, what were you saying?
No, I love that. I think that's brilliant. And I was just going to comment on like the world has changed. Like you might have been taught by your parents who lived in a different era, and literally the days of getting a job at 25 that you keep for 30 years, and during that time you pay off your mortgage and get a pension are gone. Like
That's right.
there's so few people who actually live that way anymore. And yet most of our systems that we're kind of trained in, like paying off your mortgage, is that's what it was from. And strategically, it's like having a war plan from the 1800s compared to now. And I'm not putting people down for wanting to pay their mortgage off. I totally get it. But the reality of you having enough income and having the time to do it are slim. and I think there's other ways to maximize your equity to help both sides of the ledger, right? I mean, you can use the equity that grows in your property to get ahead on the investment that gives it time, 40 years. Doesn't matter what you invest in, you're going to do well if you've got it in for 40 years. As opposed to, like you said, waiting to pay that mortgage off and then, oh, let's start, saving money. Um, and you're probably not going to have a pension or very little pension. So, I mean, you guys run across that all the time, self-employed, and yeah, there's tax benefits, but you're also not getting the big win down the road. So, yeah, there's a lot of, it's very much a complex world that we live in, and it's not as simple as it used to be. And I don't think you can't, we couldn't tell you the perfect plan because there is no perfect plan. There's everybody has to have an individual setup. And I mean, your spouse might have a different, scenario than you do. So you have to try and find a way to make those work together too. One might work for a company, one might be self-employed, and how do you, income split and maximize all that? I mean, it gets pretty complex and goes back to having the right advisors to help you do that. And that's what you need these days. I don't think there's just one simple solution. But in terms of mortgages, yeah, there's people who are going to live with having a mortgage when they retire, and I don't think that means they're bad people. I think it just means it's a different world we're in, and it's very easy for us to all get used to having payments. And the days of buying a car for cash and never having a car loan. I mean, there's almost nobody who does that. So we got to deal in the current scenario we're in. One big thing I think about all the time is all these monthly fees that we pay now that we never did. I mean, 20-year-olds with phones are paying out, crazy amounts just to own the phone and the bill. And on top of that, they've got a streaming service for this and that and all these different like music and before you know it, you've got $300 or $400 going out every month that goes to nowhere land, and you don't win with any of that stuff. You don't even remember what you watched. So, like there's a lot of ways that we can look at. It might not be as sexy as having all access to all movies all the time, but there's ways to kind of work on small wins. And I've had this thought lately is people look for $20,000 here or like big numbers, and life and business are not about the big numbers. It's all about the little numbers. So when you have little numbers that add up as a big number after a while, that's where you lose. If you can find ways to cut costs, increase revenue, even in little ways, like you've heard from different guys who've written books. I mean, 1% increases over and over and over add up to a lot. Trying to hit a home run every time is not reality. And
That's right.
but there are things you could sit down and do your budget right now and figure out, I could hack out $100 this month. And if I do that for 12 months and I invest that, like you guys know, I mean, it adds up, but we don't mentally think that way very well. And I think it's a good reminder that whether you're borrowing or investing or whatever you're doing, think about those small numbers and work hard at fixing those.
Yeah.
Yeah.
You said a lot of really interesting things there, because I think in the last 25, 30 years, there's been a lot of disassociation with the value of money through electronics. Now I can tap my phone and pay for something, and the new generation, they don't have that tactile feeling of you open your wallet and you're like, shoot, I got $100 in here and I don't get paid till Friday. What am I going to do? Right? They've never had that experience. And it is a different era, and it's a total, they don't have that sensation or that feeling anymore. And it's an interesting thing. But on the financial planning advice stuff that you were talking about, is I totally agree. It's super frustrating for professionals like Vishal and myself that you hear these talking heads. They're not even Canadian, and they'll say you should buy a home that you can pay off in 15 years, and it's only going to be $350,000, and you're going to allocate this much money. And it's like, man, there hasn't been homes available in Vancouver for $350,000 for years, and it will never get back there. And and so it's frustrating for us, and then it creates anxiety for the clients. They're like, well, this world famous financial guy is saying this, and it's like, man, that's not here.
No, and like HGTV, you watch these guys buy a house for 100 and fix it up and sell it for 300. They're in Eastern Tennessee, but that part doesn't seem to matter. But people get that perception, and then they want that. They want a brand new house when they look. They aren't willing to look at something that's not perfect and needs some work. But yeah, anyways, it is a different era, and we have to be I don't know. We have to educate our friends and family, and keep reminding them that we've got to adapt to what's going on now, not what happened 30 years ago.
Yes.
Yeah. Just quickly before we run out of time here, because we want to keep it for use. Those of you watching that have been watching us the whole time, you can tell we've shortened the episodes because commutes have gotten shorter, so we're trying to fit it in there. But Mike, there's two main differences of mortgages. People can get fixed or variable. So I want to talk about that, and then we'll end off by just sharing some stories of bad situations that we've seen our clients fall into when it comes to being in the wrong mortgage. So high level, variable, fixed. What is the difference in the benefits of both?
Yeah, in a really simplistic way, a fixed rate means that you're choosing a term. Let's say it's 5 years. That's the most common one. That's what the banks all push everybody into. So 5 year fixed means that your rate and your payment are set for the next 5 years. You can adjust your payment, but it's going to stay the same unless you want to change it. And it gives you it reduces your risk. You know what's going on for 5 years, but there's also a tougher penalty to get out of a 5 year fixed rate sometimes. So if you're in at 4%, and your payment is set at 4%, and 3 years into it, because most Canadians only last 38 months, 80% of Canadians change their mortgage in 38 months. Um, if you need to make a change and that 4% mortgage, now the current rate is say 3%, the bank, especially the big banks, are going to say to you, hey, we're making 1% less if we lend out that money now. So to break this mortgage, you're going to have to pay that difference. And it can turn into a pretty big penalty. The benefit of variable, on obviously rates can go up and down. When you're in a down rate scenario like we are right now, it's the choice is easy because you know rates are going to come down, so your payment's going to come down too. But the flexibility that I like about it is it's only ever a 3 month interest penalty to get out of that mortgage, never changes, and that's a huge piece to giving you flexibility down the road. The other big piece to it is called convertibility, and it means that you can lock in at any time to a fixed rate. So let's say you float down for the next 2 or 3 years, you feel like rates are starting to go up. Now you can lock into a 5 year fixed rate or even a 10 year fixed rate if you want, as long as you take as much time as you have left or longer. And that means it gives you that flexibility to read what's happening in the market and make a decision. And that's to me the biggest difference and the biggest benefit to the variable rate. But yeah, in general, those are the two big differences. But they're mortgages are not all the same, and I hate sounding like a mortgage guy, but like people think they're all identical, and the banks want you to think they're all identical, and they're not. It's apples and oranges, and some of them, there's literally still locked in mortgages where you can't get rid of your mortgage unless you sell your house, and those
Wow.
are closed, and you literally cannot pay a penalty to get out of it unless you sell your property, and people think they don't even think about that, and we know which ones they are. There's lots of different little pieces to mortgages that you're not aware of. So although it sounds simple, they're not all the same, and you really need to be aware of what you're signing into, and have somebody who can give you objective advice. That's huge.
Yeah, I think on that note, there was two bad situations I saw. So during the whole COVID time where house prices were nuts, we had two clients, two different clients. Sorry, I had two different clients that were approached by the realtor. One was a family friend, one was like this random door knocking realtor, and they're like, hey, I can sell your house for X. So one of them was like, I can get you like $3 million for your house, no subjects and whatever. They're like, oh wow, and that was like the family friend. And the other one was like 1.2-ish, and like, yeah, we can sell your house, and that was the random realtor. So in both those situations, they were both in fixed mortgages that they weren't, like, they didn't really know what that meant. To Mike's point, they didn't really know the terms of it, which isn't really their job. It should be the professionals around them, but you should obviously know what's going on too. But anyways, sold their homes, and once the contract was written, house was sold, they got the money and all that stuff, and they realized like, oh, what? Like, I had this penalty for a fixed mortgage. So what happened was for the larger one, they had almost like $83,000 penalty on breaking the terms because they were just freshly into their rate. So they locked in to get the good rate, locked in for 5 years, broke that very early on to sell their home for this amazing price, and they had to pay a massive penalty. Paid the penalty, and then what they realized is like, okay, well, now we gotta live somewhere. So when they started looking for a home, it was almost impossible to find a home because where they were in proximity for work, where the kids went to the school, they had to be in this neighborhood. Couldn't find anything. So they ended up having to rent a smaller space that was like half the space that they had before, and trying to figure that out until they could find something to buy back in. When they could eventually buy back in, they ended up not even breaking. They broke even at the end of the day. So all that stress, all that stuff
Oh,
for nothing. They sold their home, paid the penalty, had to rent somewhere, spent the money on rent. We could finally buy back in. It ended up breaking even. And it was a very similar situation for the other client as well because it's just different numbers, but it's the same idea. But they actually lost some money by the end of the day when they had to pay the penalty and eventually buy another place. It was just really, really tough. So depending what your life situation is, to Mike's earlier point, variable life is variable. Maybe variable mortgage makes sense for you, or if you're in a period where like I know I'm not nothing's really changing for 3, 4, 5 years. Either way, it's good to talk to your professionals and be like, what makes the most sense for me, and make sure you're talking to an objective professional or someone that has a different professional responsibility, as opposed to just a salesman that's going to get a commission and their income is derived from you buying this one specific thing from this one specific company, as opposed to here's all your options and you tell me what you need and then we'll place it with the right person. So those are some bad stories. I don't know if you guys have any as well. I'm sure Mike has a ton, but
yeah. But I think to your point, like it's too easy in our life to get caught up in the short, like, oh my God, $3 million or whatever the price was, as opposed to what's the big picture? What are we going to actually do if we move, and how much is it going to cost us? And I'm actually a big believer in actually getting pre-approved before you sell. So what that means is look at all your numbers and break it down to what it's actually going to cost you to do this and what you're going to gain by moving. And is it really worth it? It's always sexy to go, oh, I'm going to get a new house, I'm going to make lots of money. But in the end, if it's going to be a break even, is it really worth it? Like, probably not.
yeah, because there's a ton of fees. There's like when you buy the place, then if you're someone that's incorporated, do you have to show more income and pay more tax to get approved for that mortgage? Answer is probably yes. And now that's also going to cost you more money when it comes to property transfer tax, GST. Is there any renovations you have to do if yeah, I don't know if you have a dog and you're all right, well, I need laminate flooring instead of this carpet. These are all things that you need to look at, and sometimes you may actually lose money by moving, even if you make
Yeah,
a profit on your place. So you just got to be aware of all the intricacies when it comes to that.
yeah,
That stuff really aggravates me because, like, as a financial professional, if we did something like that and caused a client $83,000 of harm, we would lose our licenses.
yeah,
And there's other industries where they can do all that stuff and make a commission and walk away, and there's no recourse.
yeah. And
Yeah,
the other thing is, to back to our point about HGTV in Tennessee. Um, there's a lot of tax in BC and Canada, and there's a lot of like, uh, if you're a homeowner, you just filled out the vacancy tax thing you have to fill out to say that you live in the property or don't or whatever. And like, there's so many little pieces now that apply to us as homeowners that you forget about, and just like so many little chunks of money. And going back to our knowing your budget, same thing. Know what it's really going to cost you if you want to make a move like that. And yeah, it's our world is so much more complicated now than it ever has been, and you just need good advice and experts that know what they're talking about, not people who are just selling you something.
absolutely.
Correct.
On that note, thanks for joining us for another episode of Portfolio Talks. If you have any questions about all this mortgage scary stuff that we just talked about, or if you're just, I have no idea where to go to get my problem solved, get in contact with either one of us. Drop comments in the section wherever you're watching, and we can help you out because a mortgage is going to be the biggest debt, the biggest payment you'll have in your entire adult life. So it's very important that you do your due diligence and make sure that you know all your options before getting into that or getting into another one. So any questions, let us know. And if you got value from this, like, subscribe, share, all that fun stuff, and we'll see you next week.